In the last lecture, we discussed non-current assets. Now we are going to discuss current assets. So what are assets? Assets are the resources we own and control and are used to generate future economic benefit. This was the definition of assets. Let's see how it applies on current assets. Current assets are basically the assets that are short term in nature, which means that they will be consumed, used, utilized within 1 year or within one operating cycle. Now let's read the definition. Current assets are short-term resources owned by a company that are expected to be converted into cash, sold, or consumed within one operating cycle. These assets are essentially managing daily operations and ensuring liquidity. Now, we understood liquidity. Liquidity is how much the asset is able to be sold within an year. How easy it is to turn the asset into cash. Now, in a business, liquidity is typically referred to as how much money the business has, how easy it is for a business to raise money, to raise cash. The more the easier is a business able to raise cash, the more liquid it is concerned. The more difficult it is for a business to raise money, the more non-liquid the business is. So it is very important to get a hold of these definitions, these terminologies, because these will be used more frequently from now onwards. Because we have moved into an in-depth of the accounting systems, accounting entries, it is important to have a know-how of these definitions and knowing them by heart. When a person tells you an asset, you should have an instant click of what an asset is. Features of current asset. They are short term in nature, which is they will be used, utilized, sold, consumed within 1 year. They are highly liquid, which means that they can be easily be sold in the market or converted into cash over a short term. Now, frequent turnover. These assets are continuously replenished as part of the company's operation. Now, how is it possible? For example, if I produce if I produce mobile phones, so mobile phones have screens in them. If I produce 100 mobile phones per month, I will be needing 100 screens per month. So as soon as I complete my first batch of 100 phones, the inventory, the stock, the 100 screens I have will be finished. In order to produce 100 more mobile phones, I will need 100 more screens. So this is called replenishment of assets. I will ask the seller of screens, I want 100 more screens. He will give me 100 more screens. So this is the replenishment of assets. That is also called inventory. Inventory is basically the assets we have that are there for sale in our business and will be sold within an year. Now, relevance of daily operation. Current assets are primarily used to fund day-to-day business activities, such as paying suppliers or meeting payrolls. Current assets Have an example of cash. Cash is a current asset. Cash is used to fund daily business operations. In order to pay our employees, in order to pay our suppliers, we need cash. So this is a typical example of a current asset. We'll discuss more of them here. So current assets involve cash and cash equivalent. First, cash. Cash is money, hardcore cash, without even holding it. If it is in your bank account, we consider it cash because as soon as you swipe your card, the money is transferred. So it is cash. Cash in bank or cash in hand, both are considered as cash. Now, what is cash equivalent? Cash equivalent is a highly liquid investment that is revolving in the market. So, what can it be? It can be a treasury bill or a market fund. You can consider cash equivalent as anything that has the equally liquid nature as cash, which means it can be given into the market to someone else who will consider it as equal to cash. Then marketable securities, that is short-term investment that can be quickly sold for cash, such as shares. If you have seen in the market, you have heard the word shares. Shares are basically some an asset which can be sold within a minute or bought within a minute. So it is very liquid and can be sold quickly and easily. Now, account receivable. Account receivable is a fancy word, an accounting term for the money we need to collect from the market for the credit sales we have done. What are credit sales? Credit sales are sales we have done for which we will have to receive money will be which will give us money back in some time. So we have given the goods, but we will receive the money in some time. So the term is referred to as account receivable. So the goods we have sold in this year, we will receive the money for them for this year only. So this is a liquid asset. So the money owed to the company by customers for goods or services sold on credit will be received this year. So it is money that we are going to receive. So it is a current asset. The inventory, as I just discussed, that are available for sale, including every type of goods or services that are in my business, are referred to as inventory that are available for sale. So that is a current asset as well. So here we end assets. Now we move on to liabilities. What are liabilities? Liabilities are an opposite of assets. Assets are the things that we own and control and will earn future economic benefit. But liabilities are something that a person or company owes. It is the money or a fixed amount of resources we owe to someone. We have to give back to someone. Normally, it is sum of money. Liabilities are settled over time through the transfer of economic benefits, including goods, service, or money. Liabilities we have to pay off, we have established that. And how much time we have to establish, that can be considered whether it is a non-current liability or a current liability. That we'll discuss shortly. A liability is generally an obligation between one party and another that's not yet completed or paid. It is an obligation that is not yet completed or paid. Just for an example, I have taken goods from a supplier. I have taken goods from a supplier. That is a credit purchase. We have done a credit purchase. And for that credit purchase, I owe the person certain amount of money. And a certain amount of money I have to pay in a certain time that we discussed. This is called a credit time, credit duration. So the credit duration is 30 days. After 30 days, I have to pay the person money. Now, once I have done a credit purchase, I have an obligation to pay the other person in 30 days, and it has not yet been completed. So this will be accounted as a liability. I will record a liability of the amount of credit purchase. For example, that is $100. I will record a liability of $100 because I have not yet paid the person. As soon as I pay the person, I will remove the liability. So a financial liability is an obligation in the world of accounting, but it's defined more by previous business transaction, events, sales, exchange of asset or services, or anything that would provide economic benefit at a later date. So it is defined by more a previous business activity, business transaction. Just example, we took that we took goods from a supplier. So it was a previous business transaction. The credit purchase was a previous business transaction. It was an event in the business where we took goods on credit from supplier. And now we are going to use the assets we have taken, the goods we have taken on credit to earn money at a later date. But because we have taken goods from the supplier, we will have to pay them. Until we have paid them, it is an obligation not yet completed. Till we have paid them, it is a liability for us. For to sum it up, to have a context of asset and liabilities, we have an example. Taking an example that I am producing phones. Now, in order to produce a phone, I need the screens of the phone. I'll take the screens of the phone from a supplier, and I'll have a deal with the supplier that I'll pay you after 30 days. Okay. Now the screens of the phones are in my custody, are owned and controlled by me, and will be used to produce mobile phones that will be sold in the market. So this means it qualifies for the definition of an asset, and in specific, it is an inventory for me. So the screens that I purchased on credit are an inventory for me now. This inventory is now mine. So initially, we could say the screens purchased on credit are now my property. will be classified as an current asset, specifically inventory. But now I have to pay for it. So the payment is not yet been done. So it is an obligation for me to pay for the screens I have taken, which means it is a liability for me. So in this situation, you see we are using multiple terminologies, multiple situations. Here comes a credit purchase that is converted into a current asset. Then the payment for it is an obligation, which is a liability for it. So to understand liability in very, very simple word, it is a burden on you. It is a burden you have to carry, and in short term or long term, you have to pay it back. You have to move the burden from you. So a burden is a liability for you. Let's move on to non-current asset, non-current liabilities. The same concept of non-current asset applies for non-current liabilities, which is that it is for more than 1 year. It is a long-term liability. It is a long-term obligation. It is a long-term burden that will be for more than 1 year or more than one operating cycle. These liabilities typically support long-term investments or growth. For example, you are building a new factory, that is a non-current asset. Look, for non-current assets, we need non-current liabilities. In order to make something big or purchase something big that will last for more years, we need something big. We need some big money. We need some big amount. We need some non-current liability in order to make a non-current asset. We need big investments to make a big factory. So both of the things are linked. Features of long-term non-current assets or non-current liabilities, we could say, is long-term obligation. We settle the liability for more than a period, more than 1 year, which is typically because the amount is so huge, it is impossible for a business to pay it in 1 year or completely move off the burden from us in within a year. Then, used for capital investments. We just discussed capital investments, capital expenditure here in a non-current asset. Capital expenditure or capital investment is the production or acquisition of a new non-current asset. So in order to have a capital expenditure, we need capital investment. That is a huge investment. Now, for this investment, when we borrow money from someone, when we take money from someone, they are going to charge us something. That something is known as interest. They are going to charge us some money in order to let us keep that money. So it is a simple example of rent. If you are living on a house, in a house, and you don't own it, you will have to pay rent. Similarly, the money in non-current liabilities, we don't own that money. So we have to pay a rent for that money. That is known as interest. Now, impact on solvency. Proper management is crucial for maintaining the company's solvency and creditworthiness. Not now, what is solvency? Solvency is, you know what is liquidity. Liquidity is the ability to convert our business into cash instantly. Now, if we are not able to convert our business into cash, which means we are not able to fund our current business activities. So here, current assets are primarily used for funding day-to-day business activities. If we are not able to fund our day-to-day activities and we are having lack of liquidity, it means that we have solvency issues. Solvency is basically another word for liquidity. If we are able to convert our resources into cash frequently, we are able to manage it properly, we are solvent. But when we are not able to have a liquid business, we are not able to convert our assets into cash, we are having solvency issues. We are having money issues. We are not able to pay off our debts. For example, for long-term assets, non-current assets. These are long-term debts, which are loans, bonds, loans and bonds typically from bank. Debentures are also type of a loan that we take from a bank that are long-term in nature that we have to pay back in more than a year. Deferred tax liability is the tax. Just take it as an example that the tax that is owed to the business, the tax we have to pay. Lease obligation, that is we have to pay back, we have to pay a rent for the assets we own. If we are taking a premises and we have to pay a rent for it, and for the rent is huge for a year, it is a lease and we have to pay it back in for multiple years. So this is a lease obligation. Focus mainly on this one. These all are little complex for their stage, but are example of non-current liabilities. But these liabilities will be tested for this exam. Now moving on to current liabilities. As same as current assets, current liabilities are short-term obligations that a company is required to settle within 1 year, one operating cycle, which is longer. These liabilities are typically paid using current assets. Now, current assets are cash, account receivable. When we receive money from someone, we have cash that is in current asset. Then we use it to pay off a current liability. So current liability is an easy concept. You can easily grasp it because we have discussed current assets in detail. Now it is a short-term obligation that we have to pay in 1 year. It is paid by current assets. We've discussed that. It is recurring in nature, same as current asset. It will be coming again and again. In the example above that we are purchasing screens on a monthly basis. So it is a recurring in nature. So we are having a credit purchase every month. So we are generating a current liability every month. So it is recurring in nature. We have to pay salaries every month. So it is recurring in nature. It is to be paid every month. Now, impact on liquidity. Adequate management of current liabilities is essential to maintain liquidity and avoid financial strains. If we owe the money more than we own, we have liquidity issues. If we don't have enough cash to pay off the people that we owe money from, if we owe 100 rupees and we have 70 rupees cash, it means we have liquidity issues. So, a management of current liabilities is very important in order to avoid liquidity issues. Some examples: account payables. When we have a credit liability, we have a credit purchase, we say it is a liability, which means we have to pay money. As same as accounts receivable, we have to receive money for credit sales. Here we have purchased for on credit from someone. For credit purchase, we have to pay money. That is why it is called accounts payable. It is the amount owed to supplier for goods or services that we have received on credit, as for the example of screens I have taken above. Now, short-term debt. Short-term borrowings from friends and family or from any person within who is to be repaid within months. It is called a short-term debt. Accrued expenses. Like for example, we have used a service of the employees and we are unable to pay the employees. The payment was due for the end of this month. We are unable to pay it. So it is a liability for us now. Now, unearned revenue, which means that we have taken money from someone and we have not provided them with goods and services. This is called unearned revenue. We have not earned the revenue, we have not earned the money we have taken. It is a short-term liability. So shortly after you have taken the money, you have to pay back by providing them the services or the good. So this was the end of non-current liabilities or in all liabilities. From the next lecture, we'll start to have the numerical parts also. We'll start to see the numerical parts of accounting also. So till then, I'm signing off. Allah Hafiz.